one of our VIP members, Maureen, wrote in with a good question and suggestion. And this relates to a trade we recently did in one of our, well, actually a couple of our services. Um, but she wrote in saying she was able to successfully apply a recent adjustment we did on an IWM position. She was impressed by it. Thought it, was pretty remarkable, and his experience the success with prior adjustments that we have done in our option selling services, but had some questions about the kind of rationale and mechanics behind it. So, like, how do you decide which strikes to adjust to? When do you add a spread? So in this case, it was a bear call credit spread that we started with, and we actually adjusted into an iron condor. And then how would you select the strikes for the put spread that was added? Um, and there were some other kind of details in the question that I'll get to. Um, but let's start with the initial trade, which again was a bear call credit spread on the IWM, where we had set up a 205, 207. So the short strike was at, I'm just roughly drawing these, was at 205 and the long strike at 207. So it was a call credit spread. We put that on, back. Let me actually look and see. I believe it was on May 2nd. So right here. Okay, so IWM was trading well below uh, that resistance area, and the strikes. So in terms of strike selection, I'll start there. Couple things. I use kind of two different metrics. One, first being technical. So I try to, when I'm selling a call credit spread or a put credit spread, try to align my short strikes in the case of a call credit spread with a key resistance area, and either you place the strike close or above. So that's what was done here. There was prior support from back in September. Um, and then so that's kind of more of the technical basis, and then the other is, clear that up. Related to the option statistics. So I'll just go out just to give kind of an example. Again, this was done back on May 2nd, but um, we'll focus more on this in terms of the adjustment component, but looking at probability. So I'll typically establish a spread with a short strike around a 20 delta. Okay. And so I'll look for that 20 delta so for instance, if like a 20 delta strike is below a resistance level, I would pass on the trade. You want that 20 delta to be at or above that key resistance level, which it was at the time. And then looking at other probabilities, again, we'll get into this in more detail in just a second, but so a 20 delta is typically going to have about a 80% chance of expiring out of the money. So I look at probability out of the money. Also probability of touch. So what is the likelihood of the underlying touching that price level between the trade entry and expiration? Okay, so those are some of the things I'm looking at. And then I'm also looking at volume and open interest. Okay, and again, we'll look at this as it relates to the actual adjustment. So yeah, I'll get to that now. So what we ended up doing, so if we go back to the chart, okay, what happened here is, and this was around uh, news that came out over the weekend, we had a big gap up in the IWM. And in fact, we gapped up on the open, not just above the short strike, 205, but also above the long strike at 207. So it completely blew through the spread and actually gapped up into the next area of resistance. So we had just previously mapped that out right at 210. All right. So the next step is, you can either just accept the loss or go to work and adjust the position, which is what we did. And the next step was then to, always know where your levels are, was to determine, okay, we've now rotated up into the next area of resistance, and we now have consolidation below that resistance area. So we adjusted this last Friday. Okay. So it appears the resistance area is holding, and that would create a scenario where it might be appropriate to roll the call spread out. So this was initially done, the initial 205, 207 call spread that had a May week 3 expiration was initially done for, I believe, a $45 dollar credit, so 45 a contract. Okay. So the short strike is now in the money at expiration. And when you roll a call spread out that's in the money like this, oftentimes you're not adding all that much risk, if any, depending on how deep in the money it is. So the max risk on the initial call spread is just the width of the spread, which is 2 points. It was a 205, 207, right? Minus the credit received, which is 45. Okay, um, so $1.55 is the max risk. And in this case, we could receive a credit pretty close to that, right? So on the call side, we'd just be adding, again, the risk would be the difference between the credit received, which is now going to be much higher on a rolling adjustment, subtracted from the width of the spread. So we're not adding all that much risk on the call side just by rolling the spread out, but it gives it the opportunity that if you get a pullback, right, you can capture that premium and mitigate or completely, even in some cases, completely cover the loss on the initial spread. Okay, so that was one step that we took. And again, the rationale there is we want to look at resistance. Is it holding? What was the prior context of the move? Parabolic up move. We haven't had any pullback at this point. Okay, so that all makes sense. And so what we did is we went out to, let me move this, the May week 5, so May 30th expiration. Okay, and simply kept the same strike prices, same number of contracts, rolled the spread out. So here's where you want to, and these have changed since the adjustment was made on Friday, but you want to be looking at probabilities. So here um, so we want IWM to come back down to 205 or below. Okay, and we want to see a good statistical probability of that happening. Okay, again, this changes, but this is as of today, um, so not necessarily as of when the adjustment was made on Friday, but um, I like to see, so this is probability of touch, meaning that between now and May 30th, the probability IWM is going to come back down to the 205 level. It's currently just over 57% chance. Okay, and I want to see that certainly be better than a flip of the coin chance. And ideally, in the 60 to 70% range. And likely that probability is higher than statistics would indicate because we're also combining technical analysis, right? The resistance level, the context of the prior parabolic move. Okay, we're well off the 20 period mean. Okay, so a mean reversion is more likely. Okay, so we have just by extending the time horizon, a pretty high probability of trading back down to 205 or below. But what we also did is we added a put spread. So we converted this into an iron condor. So an iron condor is just a combination of a bear call credit spread and a bull put credit spread. And so typically when you set up an iron condor, you're going to set up short strikes on the call side and the put side that are equidistant from the current price of the underlying. So it might look more like this, where you have your short call and your short put strikes. In this case, we already had a prior bear call credit spread, so we just rolled that out, just added a small amount of risk to the position by doing so, but increased our probability of success rather than just taking the loss. But then we also added a bull put credit spread to bring in additional credit. And so that's what converts it into an iron condor. And we did so with a short put strike at 200, and then our long put strike at 198. So also a 2-point wide spread. Now, why was that selected? So same thing, support. And we previously mapped this out when we did our market over. Okay, so if we do get a pullback in the IWM, and this has risen a bit since the adjustment was made, but we have pretty close confluence here with our 20 period mean, which is actually now just above 200, and that's good. Okay, and then we also have our static price level of support. Okay. So what that does is it brings in some credit. Okay, not as much as the call spread because that was rolled in the money, but that brings in some credit. If IWM continues to rally to the upside, had we not added the put spread, right, it would add some of that loss, because remember, we're adding a little bit of risk by rolling the call spread out. The put spread will mitigate that. Okay, if we continue to rally. So you would capture the credit on the put side. And adjustments should always be looked at as kind of a work in process, right? There may be additional adjustments that we do. We may end up rolling the call spread again. And we may roll the put spread up and strike if we're making money on that side of the iron condor. But this is a relatively tight, 5-point wide iron condor with our short call to a 5, short put at 200. So the best case scenario is IWM pulls back into this support resistance range. So this position was adjusted into an iron condor for a $1.61 credit. Okay. So, if you'll recall, it was put on for a $45 credit, debited at $1.55. Okay. So that's our, had we done nothing, that's our loss on the, would be our loss on the position. But we've now given this position a chance to uh, have a net profitable outcome if we pull back into this 200-205 range. Again, using support and resistance. So the strikes are selected based on deltas, based on support and resistance, based on probability of touch, and all those things kind of coming together. The nice thing about adjusting the iron condor is, again, if we do get a continuation of the directional move in the direction of the breach spread, right, we can manage the put credit spread by rolling and bringing in more credit. And it's also going to, buffer any buffer loss on the call side. It gives us more flexibility to manage the position through future adjustments if needed. Um, and an iron condor doesn't add risk in the sense of, think about the way to put this. So if you just do a credit spread, so just one vertical spread, whether it's a bear call spread or a bull put spread, right? In terms of the debits and credits, so if you add, let's just say you start with a call spread, right? Well, obviously, if you add a put spread and make it an iron condor, you're going to bring in more credit. But you're not increasing your risk exposure because you can't lose on both sides of an iron condor, right? You can only lose on one side. So if you lose on one side, right, the other side's going to win. So that's kind of the power behind the iron condor. And so if we come down, IWM starts to trade lower, right? We're going to capture all that premium on the call side. And in the case of this rolling adjustment, a lot of that credit came in from the call side because it was in the money. So the rolling credit, I think, was around $1.45 or something, $1.50, somewhere around there. Okay. So that actually covers the risk in the put side. So even if we trade down and breach through the put side of the spread, the call side protects that. Now, we wouldn't have been as well off had we only rolled the call spread and not added a put spread. But remember, that can also be adjusted if needed down the road. Okay, so there's kind of I realize a lot of moving parts there and things to consider, but that's one of the common ways I'll adjust either a bear call credit spread or a bull put credit spread if it's breached, is to convert it into an iron condor.